Goldman, we have as our keynote speaker today. Thank you, Arthur, for being here, sharing some of your wisdom and knowledge. Arthur has an extensive background. He's a CPA. He's helped build Freestone here in the Seattle region early on, and has a lot of experience with term sheets. He's an active member on our term sheet committee and really specializes in convertible notes. We've learned a lot from Arthur since he joined as a member a couple of years ago, and we thought it'd be great to be able to have him here today to share a little bit of his thought leadership around this subject. So with that, Arthur, I am going to turn the meeting over to you and give you the ability to share your screen, and we look forward to learning something. So thank you very much for donating your time today.
Okay, well, thank you for the nice introduction. So today, the title of my presentation will be using term sheets to make better investment decisions. And when I was looking at the problem, I felt like us as angel investors are like kids in a candy store. Keiretsu brings all these great companies, and we want to invest in all of them. They all give these great pitches. They all sound great. But in reality, we know a majority of these companies will lose money on. So how do we narrow down the field and have a really good, cost benefit, risk reward type thing? And one of the ways to do that is through the term sheets. And today I'm going to focus on, just because limited amount of time, I'll focus on convertible note term sheets. I will occasionally refer to maybe a preferred offering or a safe, but in most of the stuff we're talking about today, it will be convertible notes. And one thing I'd like to stress to you is that when using convertible notes, they're just a tool. They're one tool that goes along with, the company presentations, questions, cap tables, and financials. So use that tool to gain a better understanding of the big picture. And what I like to do, and I highly recommend this, is coming into a presentation from Keiretsu, I find out there is so much information to learn in 15 to 20 minutes. It's hard to take it all during that presentation, take it all in. And so if you can get the term sheet before the presentation, or what I used to do when they had the meetings over in Bellevue, I'd show up a half hour early, is to actually read and get a good understanding of the term sheets, and that will help you better focus on the presentation when the speaker is speaking. So what I'm going to try to do is, because we might run out of time, is to talk about certain terms that work or certain terms that I have problems with. I have more explanation further in the analysis here or the presentation, but I just want to make sure I touch on a lot of them here. And I won't go into too much detail, except maybe on the first one, just to show you how some of these things work. So one thing that we don't want to see is when we find that great company, when we find that unicorn, we need to make sure that we realize the value when the company has that big payoff. And in the very first Keiretsu company I invested in, I noticed on the term sheet, they had the ability, the company, to prepay the note. And I thought that was really interesting because to me it said, well, the day before they go public or the day before they get bought out, the company could prepay the note. So I looked further into the convertible note, and I found 3 or 4 areas that were just major terms that didn't make sense. And when you start seeing this type of stuff, what we find out is the company will have an attorney who doesn't understand angel investing, doesn't understand convertible notes. And unfortunately for us is that the founders usually don't understand them either. They're relying on their advisors. So in this case, when I went back to the founder of the company, I explained to him some of the problems. He went back out to another law firm, verified the problems were legitimate, and realizing his attorney didn't have the ability to do a good convertible note, went out to another law firm to get a note done. And then, I hate to say this, but a lot of investors had already invested with them on the old note that didn't make any sense. He went back and put everybody under the new terms that didn't make sense. So really what I'm saying on the first dot point and even the second dot point is that we've got to make sure our interests are aligned with the companies we invest with, particularly if the success happens. And we'll talk about some other situations and notes where that's not necessarily the case. one thing you don't see in the term sheet typically, but I do see when I see financial statements or cap tables, is I see other debt. And I really have a problem when the money that we're investing in the current round isn't going to grow the company or to make it get ahead, that's going back to pay prior loans, particularly if any of those loans are to the founders of the company. Next thing is valuation caps. So I know, Brianna, you mentioned you're going over that, and to Nathan and Brianna's credit, what we see finally get to the company is usually much different than what usually shows up at Keiretsu's doorstep. And most people have either a really high value of what they put on their companies or just are being really unreasonable. And so very often, Brianna's able to get them down to a much more reasonable valuation, but that's not always the case. And to have the real risk reward that we're talking about, you need to pay attention to valuation caps. That doesn't mean, like the first company I mentioned, their valuation cap was 17 million. You just have to look at the whole big picture. It's not the number itself, it's just how is the whole big picture. You look at the whole big picture. And then the next thing that you have to take in consideration when I look at convertible notes, if this is a successful company, I want to make sure I have that chance to convert. Very often we'll see companies coming in that are getting very close to cash flowing, or maybe they say in the next round they're probably going to do another future round of convertible notes. And if there's a chance that they won't need the capital to cause a qualifying event to make my convertible note convert, I need to make sure when my note matures that I have that ability to convert into the company's equity. And there we go, the terms that make me pause. So there's one thing for me to have that option, but sometimes we see the companies have the option to convert at maturity. I'm okay with that if I know what I'm converting into. Typically, when you have a qualifying event, you actually have a lead investor or you have a group of investors that are negotiating terms. So I will at least feel like there's some people whose interests are aligned with mine to negotiate terms. If it's an automatic conversion at the end, there is nobody negotiating the terms. And so I want to make sure I'm not ending up in common stock if I can avoid it. I prefer to end up with preferred stock and have a lot of rights and benefits that I'll talk about further on in this discussion. Another thing that I don't like is I'm seeing more and more of these convertible notes where they allow the majority vote of note holders. These are people who invest at the same time that you do on these convertible notes to control decisions. And I don't want to be worrying about that there might be a majority holder or a lead investor that they have something going on in their life that doesn't work with my life. For example, maybe their company's doing bad and they need cash. Maybe there is a death and they need to pay estate taxes. I don't want someone else's financial decision to determine my financial decision. If it's a majority vote, then I want to make it much harder on the company, and I usually like to see a supermajority of 66 2/3 or higher. Another thing that's going on that we're seeing lately with, been seeing all along with convertible notes is you may see a round that's taking 6 months to a year to actually raise the money. And then the question you have to ask yourself is, if these are 3-year notes and someone came in 6 months and 9 months before me, do their notes mature 6 months or 9 months before me? So sometimes they do, and other times the way the convertible note is written is that there's a starting date based on the first note, which I think is the right way to do it. And then all the notes convert at one time. Because we really are a group of investors investing in the same note at the same terms of the same rights. So we all should mature at the same time. And the last point here, and I'll just say that I usually like to see a C corporation US entity. There's special benefits for QSBS stock, and I wrote that down. It's qualified small business stock. Most of you guys are aware of that, but if you aren't, that's the ability, if you hold the stock for 5 years, there's potential to avoid up to 10 million in capital gains down the future. That is something that's real important. And there's a lot of other issues that come up with which are beyond the discussion today if what you're investing in is an LLC, a partnership, or an S corporation. Okay, let's have a little bit of fun here. I am curious, by a show of hands, and of course I just lost the presentation here on the screen. Let's see if I can get it back.
We still see it.
You still see it?
Yes, sir.
That's funny. I lost it on my end, but we'll see if we can, okay, there it's back up.
All right.
That, by show of hands, how many people, when they're looking at a company coming through and listening to the presentation, think that they're aware of the pre-money valuation? Raise your hand. I would hope most people are raising their hands, even though I don't see most of them raised. Because remember, valuation is one of the key components. Now, how many people, by a raise of hand, actually know the post-money valuation on the investment they're making? This is something I'm actually going to bring to the term sheet committee, because while the pre-money valuation is interesting, it really doesn't mean very much. The thing we should be focusing on is the post-money valuation. And what impacts that post-money valuation? It has mainly to do a lot with what I call fully dilutive basis and that definition. And usually when I think of fully dilutive basis, that you have to take into the valuation previous warrants, options, and other convertible instruments, employee stock plans, et cetera, that actually determine the valuation of what you're receiving. And by way of example, I think most of us are familiar with Shark Tank and watch Shark Tank. And the very beginning of Shark Tank, when the investor comes in, you get a presentation like something like, "Hi, I'm Dorothy from Kansas, and I'm looking to raise $100,000 for 10% of my company." What that translates is into a post-money valuation of $1 million on the company. So in Shark Tank, they're always starting with a post-money valuation. And you've probably noticed they've never, ever asked if there's any option warrants, convertible instruments, because I am willing to bet that in order to get on Shark Tank, when you come in and you give that pitch, that what you are giving to the sharks is done on a post-money valuation, fully dilutive. Next thing to talk about are conversion terms. And most of us are familiar, there's a qualifying event, typically in notes, usually a price round or something. And typically we'll see the lesser of 20 to 40% discount to that next round, or a valuation cap. Now we're back to the evaluation cap can be very important on what happens. And another thing I like to keep track of is, let's say the company's raising $1 million, the amount raised. I want to see that threshold for the qualifying financing to be at least $1 million, preferably $1.5 million or $2 million or larger. It's not been uncommon where we see companies come in at 20 to 30% threshold to the amount they actually raised. And that's just too low, because then they're able to make all their debt go away for a really small amount, which they may put in themselves, or they may find a friendly investor. And there's been no one really that's been in there to negotiate what our stock or what our notes are converting into. Another conversion term that I find interesting is a sale and change of control. We just had on our term sheet committee another one come through, and we probably see at least 5 or 6 of these a year, where, let's say on the sale of the company, in there it says the investor will receive 3 times their money if the sale of the company happens before the note converts. And why that sounds great, the reality is because we know most of these companies will lose money, we have to share pro rata on the upside if we do find that company that's a 10x or a 15x. And so have a fixed payoff on an event like sale or change of control is something you want to avoid. And you don't want to have it automatic or at the company option. It should always be at the note holder's option. Then there's maturity date. And as I look at convertible notes, I only prefer to find convertible notes that, one, if there is any prepayment, it's on my specific ability, the note holder's approval, not a majority of the note holders or the company's approval. And also, when it comes to maturity dates, I tend to avoid safe securities. And that's just a type of convertible security but a couple things happen on those. Typically no interest they're paying. There's no maturity provision in there. And so what my concern is that if the qualifying event never happens, what am I? I'm in this nebulous area where I'm dead out there, not earning interest that may never be converted into equity. So that's one of the reasons I avoid safes. I've had a couple of companies that I was interested in the companies. And when I add them to add the maturity provision in there, you know, both of them said, well, if I do it for you, I have to do it for everybody. And I said, yeah, you should do it for everybody. And when they refused to, I refused to invest in the companies. Brianna, really quick, how are we doing on time here?
Great. We've got 11 minutes and 20 seconds.
Okay, good. Then I can go into more detail here.
Yeah.
Okay. So going back to how we talked about the big picture, when I'm seeing a target amount, let's say they're raising $1 million, I look at that and I look at the other presentation, a lot of questions go off in my mind, like, when did the raise start? Very often we're finding these raises that are going on for 9 months and a year. And all of a sudden something goes off in my head and say, what am I missing here? If I like it so much, why did the other companies not like it? What did they see that I didn't see? Or what has happened in the last 3 or 4 months that makes this company more interesting than it did to other investors? And the other thing I don't like to see is, I don't want to see companies where the founders and the key people are on the road all the time raising money, as opposed to directing the company to the next level. I also like to find if there's a lead investor, because very often the lead investor negotiates the terms. And when you have a really good lead investor, then you have someone helping you with your due diligence. I also like to know the amount raised in the round. And let's say they're raising $1 million. If they've raised 800,000, I have a lot of confidence the round will get done. If they've raised only 100 and they're having problems and they need the $1 million, I start having some concerns around the liquidity of the company moving down the road. We've already talked about the notes. I just want to make sure my note has the same maturity date as everybody else. I also like if I can get a cap table really quick when the speaker's looking at it. I want to know the valuation dates in terms of prior offerings, if there have been any offerings. And very often we'll see just 6 months earlier, there's a prior offering at half the value. So the question that jumps out is, what has changed in the company in the last 6 months? Why are you worth twice that value? Maturity dates, again, always an issue with prior debt. So I need to keep track of how much prior debt's on the books and what their conversion terms are. And then I have my own pet peeve. I think a lot of people share it, is that I love when investors eat their own cooking and put a lot of money in the company. I hate when the founders or everybody, when they put a lot of money in the company, but they consider it as debt of something they're going to get paid back for. I kind of go, that's why you own 60 or 70% of the company, is because you did that initial capital, and that shouldn't just be debt that's getting paid back to you. And then finally, you know, as you're looking at the presentation, I take a lot of time to really try to figure out the burn rate and the need for future capital. You know, if this is a growing company and everything's interesting, if I know they need future capital, I have a lot more confidence that my note will be converted. On the opposite end, if they have a very low burn rate, then I need to make sure that I have certain options in my note to be able to convert when it matures. There's a lot of other factors. Some are important, some really aren't. Interest rate, we typically see 4 to 8. I don't usually lose any sleep over that. Length of the note, I usually don't like to see them less than about 2 years or over 3 years. Just my preference. I think it's best. It's a kind of a nice place between what's good for the company and what's good for investors. And then we mentioned earlier about the type of entity. And again, if it's not a C Corp that has a qualifying QSBS type election going for it, now you need to do a little bit more research in it, because you could have a interesting tax impact, not to mention K1s or some other things that you might have to be filing. And it's just good to know. And one thing I can't speak of very well, but I've seen a couple Canadian entities, or more than a couple Canadian entities coming by, and I have not invested in one yet, so I haven't got down to do the deep dive in there to understand some particular issues relative to Canadian entities. So my final comments are very easy, is that we're trying to find the unicorns, and when you finally invest in them, you got to make sure there's no way for them to get away for technicalities in the documents. I also want to point out that don't assume that the term sheets or the offering documents are perfect. I can tell you that reading the term sheets or making sure someone on the due diligence committee reads it and understands what's going on is important. And when I find what I consider critical issues, if the company won't fix those issues, I typically avoid them. And lastly, because in several companies I have invested in that completely changed their documents, I was amazed the number of investors that invested before the due diligence was complete. And I just got to tell you that that's a very risky opportunity. Now, if it's something that's going to, fill up quickly and you have to move, well, now you have to make a decision. But what I found with a lot of these companies, you can kind of make that what I call soft commitment. Yes, I'm interested. I want to make an investment. I need to review the documents, and you can lock up an investment for a week or 2 weeks while you'll have time to do more research on the due diligence and on the documents you're signing. That's kind of my summary. Guess we could open up to questions or move on and have fun and start drinking beer. Oh, never mind. We got more after this. So.
Well, thank you for that, Arthur, and thank you for sharing some of your wisdom with the group here today.